Okay.
Welcome. Welcome. How's that? All right, we're good. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, back again on the Rundown Special Edition. I'm going to get hate for this. What's wrong, Warren? And I'm actually I'm being sarcastic. All the way. We got my co-founder all the way from Norway on air with us, Vetle Forslad. Vetle, how's it going?
I'm doing even better now that you called me your co-founder.
That's
I like
right.
that a lot.
Co-founder of the Rundown. That's right. You are an integral part of the process. And we're happy to.
So not focus compounding, unfortunately.
No, maybe not.
Yet.
Maybe one day. Maybe one day. That's the same.
Yeah.
One day, if we ever need extra help for research, you know who we're calling. We're calling you, my friend.
That's true. I mean, you have done that before with Netcar. I guess that could have gone better, but
you have provided good research.
Yeah. But Netcar has gone up a lot. I'm not sure why I started talking about that, but it's like, I think it's doubled since, I think it's up almost 100% year to date. It's killing it in the market these days.
Yeah. So on today's Rundown, we're going to talk about some stuff that happened throughout the week. This is a twice a week show. I think we're going to go Tuesdays and Saturdays, as long as you could fit us on Saturday with your busy schedule, Vetla. And the first thing we're going to be talking about is Facebook buying GIF, I don't know, however you want to say it, but Facebook bought GIF for $400 million, which, is interesting to me because a lot of people are saying what a miss this was by Twitter. The biggest gripe that a lot of people have with Twitter as an investment is their lack of innovation or monetization of the brand. I think Twitter, in my opinion, I still think it's one of the best kept secrets of a platform. So you have our president that tweets a lot. You have fund managers that tweet. You have Elon Musk that tweet. I mean, just the vast majority of just information, I guess, that you could get from Twitter. I mean, I personally, my life and business has benefited tremendously from Twitter.
Yeah, I mean, you get all the news on Twitter almost hours before you see it in the newspapers. Or sometimes you get it weeks before you see it in the newspapers. If there's some sort of a theory or something, you just get it, or you just get it straight from the horse's mouth. If there's some guy who tweets something on Twitter, you're going to see it right away. And then the newspapers are going to spend hours before they're actually going to write about that. So just the informational aspect of it makes it extremely valuable. And then, of course, you see all these interactions between famous people, which you don't get anywhere else in the world, in both on social media and otherwise. So it's incredible, as you say.
What I think is good about it is, I guess pre-Twitter is the media or whatever, they definitely own the narrative. And I think it's a good platform for people to be like, no, this is me. And let me, you hear it right, from me, which you just talked about. So I thought it was interesting. A lot of people are kind of bummed that it was Facebook that ended up acquiring them. I was reading in the Financial Times and they were talking about how GIF pre-COVID shutdowns, I think they went to Facebook really for maybe a potential investment. And then, after starting those talks, they ended up actually acquiring them. And, it makes sense, I guess, it would have made a lot of sense for Twitter, in my opinion.
Why?
But,
Why?
Facebook, well, I mean, because a lot of people use it and you could get, information from it.
Okay.
I mean, here's the thing, right? And I guess when you want to talk about this competition between Facebook and Twitter. So what is Twitter going to allow people to still use GIFs or GIFs if it's Facebook that's getting all that data? I don't know. So it's interesting.
Well,
what are they going to do?
I think there are several GIF operators, I guess. It's not only GIF. They don't have a monopoly, right?
I'm not sure. I don't know.
I think there are alternatives. And if there's no alternatives, there is going to become an alternative because there's certainly going to be a huge market for Twitter. To fill.
It was just
interesting. Develop their own.
I wonder if they're going to license it to Twitter, what, that's going to look like on the back end. I don't know. Or maybe it's just nothing's going to change. But then like I said, is Twitter going to still want, I don't know. I just
Do you know what the motive for them is? Do you think that they're going to use this for some greater project they're working on that we don't know?
I think Instagram, they said it was, I think 50% of their, usage, people use GIFs. So it was just to expand on that for people's ability to express themselves. I think was in another way that they worded it was basically what they were saying for the acquisition. Yeah. I mean, $400 million for Facebook is nothing,
I know.
So
yeah, it's a drop in the bucket.
Yeah. So anyways, I thought that was interesting. Next topic, Buffett. He sold most of his Goldman Sachs position.
Yeah.
And he trimmed JP Morgan a little bit, but there were no new buys. But he sold, most of Goldman Sachs, which was interesting and caught a lot of people's eyes.
Yeah, it's very interesting. And it's even more interesting when you put it in perspective, because he sort of saved, he didn't save Goldman Sachs, but he gave Goldman Sachs a lot of funding, and he invested in them at the bottom or around after the financial crisis in 2008. And that was the last economic crisis. And in the current economic crisis, he's selling them. And that should be some kind of a sign, maybe. I don't know what he's thinking. What do you think? What's the motive here?
I think he thinks the bottom isn't in. I mean, I guess, it's crazy. It's interesting.
But it goes against all Buffettology to, time the markets, to say like, I think we're going, you will never see Buffett say, in any interview that, well, I think that next year we're going to be a bit lower in S&P 500. He's never said that before, but he does have like a Buffett indicator, the GDP to the stock market index. That's at an all-time high. And he has used that before in his letters.
Yeah.
So even though it's not Buffett-like to use that indicator, maybe that's what he's seeing, and I also think that he may look at alternatives, like what can he do with the cash that he gets in equities? Where can he allocate that otherwise? I think that he might be waiting for bankruptcies to happen in the private market, in private companies. Because as I said, obviously it's not trying to time the market. That's not how he thinks. And it's mostly impossible. But it's possible to time when bankruptcy waves arrives in the United States. Because when you look around and you see that companies are going to go under, companies are going to need funding in the private market, that's just simple math. Companies are running out of money. And so he could be waiting for those companies to go bankrupt, and then he can go in and buy them for a very cheap price. I mean, that's one way to look at it.
Yeah, my two takeaways from it was that he either thinks he's going to get an opportunity to buy equities lower. You hit the point that's probably, who knows if that's what he's thinking, but so it's either that or he's raising cash for another large acquisition. That's what I thought. But nonetheless, I thought it was interesting.
It's very interesting because you're seeing a lot more billionaires talking about how expensive the markets are. I mean, Buffett, he's not explicitly saying it, but he's not bullish. So Warren Buffett is kind of bearish, I guess you could say. Druckenmiller is bearish. David Tepper. Who else? You have a lot of billionaires who are actually going.
Well, I know when everything was happening, I don't know his stance now. Paul Tudor Jones came out and said that he thought we were going to probably retest lows. The problem is with taking market calls, in my opinion, from guys like Druckenmiller, Paul Tudor Jones, and potentially even Tepper, is they could flip like on a dime. It's not much, but I do agree. I mean, what they did say was, I think Druckenmiller said, like, people that think we're going to have a V-shaped recovery are living a fairy tale. And Tepper said that this is the second most bearish he's ever been on the market. So, I mean, those are pretty bold statements,
Yeah, but both things could be true. Stock markets could hit all-time highs, and we could also not see a V-shaped recovery. Maybe, there is a possibility that equities are just going to delete 2020 from history and look at 2021, 2022. So what that's going to mean for stocks is nothing. Stocks are going to go up. But as I said, bankruptcies are still going to happen, and private companies are still going to struggle if you do not have a V-shaped recovery. So maybe that, so both things can be true. And one thing that I find very, very interesting about how bearish billionaires are is that there are a lot of retail investors entering the markets right now. And I saw a chart earlier today that retail investors have never bought more call options than they're doing today. So there's a big difference between, what the veterans are doing and what the new retail investors on Robinhood and Wall Street Bets are doing. It could be a sign of where we're going next, but who knows?
Yeah, that's a great point. The last thing that we wanted to go over is a topic you want to talk about: value underperformance.
Yeah. So as we all know, value has underperformed for over the past 3 years, the last year, the last month, the last 5 years, last 10 years. And the topic has always been very heated, like, is value dead? But I feel like the debate has really gotten even more heated up over the past months or so, because people always said that we would have a mean reversion and that during the next crash or the next recession or depression or consolidation, things would mean revert and value would outperform growth again. But growth stocks has done better. NASDAQ was up for the year at one point, and cheap stocks have gotten worse even this year, even during the rally before the coronavirus, and value stocks did worse during the crash and during the recovery. So we're not really seeing any mean reversion at all. So what do you think? Do you think that this is like a sign that value investing is dead forever?
Yeah, I don't know. I mean, it's really testing the whole, like the quote, value investing works because it doesn't work all the time.
Yeah.
But like, I do think people, they make more of a bigger deal than it is. I don't know if it's because it just gets good, it's good clickbait or what, but I mean, at the end of the day, it doesn't matter. I mean, you're buying a business today because you think it's worth more money, right? And what you're paying for it. So, I mean, I don't know. I mean, there's still opportunities out there. I think, maybe as a bucket, if you're buying like if you're a quant, buying a massive bucket, that may be more challenging. But people said the same thing in 1999, early 2000s. But no, to your point, and we've talked about this, it didn't matter what study you had to back up your strategy. It didn't matter overlooked. It didn't matter if it was a defensive stock. It didn't matter if it was a dividend paying. It just, none of that mattered during this past crash. Everything just got slaughtered. And what's interesting, what I've been doing is looking at a lot of companies that we've studied in the past, and a lot of them have not bounced back like the market's bounced back.
Yeah.
And so that's interesting.
Of course, companies like go ahead.
I was gonna say, of course, companies like Amazon and all those businesses, sort of these FANG companies, they've all bounced back tremendously well. So I don't know. I don't know what the answer is. What I do know is that we'll continue to look for companies and pay prices that we think is cheap relative to their intrinsic value, because that's just what we'll always do. But I mean, look, if you could buy a company at 30 times earnings and you think it's cheap based on the future and everything like that, is that considered value investing still?
Yeah.
I don't know. People
agree.
People put themselves in this this bucket,
this very small box.
Yeah,
that value investing just means that I have to buy something below current asset value or something. It's not about that. It's basically about buying $1 for 50 cents or 70 cents or whatever, just buying a business for below the intrinsic value. And that doesn't really have to mean that you have to buy it based on the balance sheet. You can buy it on how much they'll grow over the next decade or so. So have you heard about ACO Capital?
Which one?
The ACO Capital. It's based in London, and the next head of the sovereign wealth fund in Norway, the biggest sovereign wealth fund in the world.
Oh,
actually,
yeah.
So they run a great hedge fund. They have outperformed the market massively since the mid 2000s. And I actually had the pleasure of meeting them last fall. And their strategy is to not look at prices. They don't look at multiples. They exclusively look for the greatest businesses in the world. So they own Ferrari, they own eBay, Visa, Adobe, Nike, you name it. To just look for the greatest businesses they can find. And their thesis is very simple, that the market will always price an amazing company too low over time, that the market will underestimate the value of great businesses. So even though they don't really look at price or at multiples, that's still value investing, right? Because they're underpaying for a great company.
Yeah, I mean, no one goes and says, here's $1, give me back 50 cents. You know what I'm saying? It's not. I just think people, they just put a bucket over their head when they try to, you value or you grow. I don't know, right? Yeah. It's like we paid 25 or 30 times earnings for over-the-counter markets because we think it's a great business that generates a ton of free cash flow and float. And, based on, doing some math, we think it's cheap. And some guys would be like, oh, well, that's a high multiple, so you probably shouldn't have paid that much. But again, we think about what a biz could look like 5 to 10 years in the future. So I don't know. I just think a lot of people spend a lot of time worrying about it. Just buy cheap companies at, good companies at cheap prices relative to their, future intrinsic worth. And that's the way that we think about it.
Yeah. Maybe the fact that this is even a topic of discussion, or the fact that value or low price to book companies outperformed from, the 1960s till the financial crisis, and now they're underperformed. Maybe that means that when that value investing, you can't buy value companies in buckets. You have to look at each company, because each company is different. Each story is different, and each business is different. So maybe it just proves that systematic value investing is not the way to go. I guess at least in the modern age. Of course, it was very valuable when Graham was still alive and when Graham started out, because he was the first guy to find out about it. He invented the price to book ratio, I think. So I don't know. Maybe that's what it means.
Yeah. So, and businesses are different now too, right?
Mm-hmm.
How much of, companies have,
I think that's
intangible assets and everything like that.
Assets. Yeah.
So
yeah, it's when you look at a low price to book strategy, that's almost like comparing something that doesn't exist anymore, because it was the price to book multiple was very useful 50 years ago, but today most of the balance sheet is in intangibles, so it's almost useless these days.
Yeah. I mean, and here's the problem, right? Think about if you were to buy a private business yourself, you wouldn't say, oh, this is a growth company and I'm a value investor, so I'm just not going to invest in it. You wouldn't put that hat on. You would just say, oh, right, I think this is a great business. I think I'm getting a cheap price for it. Let's invest. So that's just the way. I think a lot of people, they waste a lot of brain power trying to, decipher it. And I get it though. I mean, different people invest differently, and maybe if you're a quant, you're focused more on, those type of factors and stuff, and that's quite okay. But I just, for our audience and individuals like you and the way that we do it, I just think, why waste time on it? Just buy, a great business at a price that's cheap relative to its future worth,
Yeah.
Cool. Have you been looking at any companies, any interesting businesses or anything? Any booyahs from you?
Any what?
Any booyahs?
Any booyahs. I constantly look for businesses. I started this thing at the end of April, where I would, I guess somewhat inspired by you and Geoff, is that I will each day, no excuse, just read an annual report. Like, no excuse. I used to read a lot of annual reports, but I didn't do it like on a regular basis, or I did it like maybe a couple times a month or a week or something. But I recently started to just read one 10K or annual report every single day, just to grow like my knowledge of companies and of businesses. And I'm finding great businesses all the time. And I think many of them are cheap. Like, I could bring up some of them. I like Track Size, Get Busy, Devhurst. I think there are a lot of opportunities in the British stock market, actually. And it's also for tax benefits and stuff for the funds that I'm going to be working for here in Norway. They usually look for European companies because of tax reasons and so on. And the regulatory environment and the investor environment in the United Kingdom is just the best in Europe. So I think, as a European investor, the best place to look is over there, in my opinion.
Cool. Well, I'll put those companies down in the description. Maybe on Tuesday we could chat a little bit more in depth about it. What I've been doing too is I've been going through like a bunch of like OTC adventures.
Nice.
So I've been going through our Focus Compounding blog and just companies we've looked at in the past. The OTC manuals on stocks and stuff like that. And I've been seeing how many companies have pretty much gone destroyed in the crash and just haven't bounced back. So I've been kind of thinking, okay, is this a business we'd be interested in? And then what has happened since? And I'm finding a lot of businesses that are still down like 40%, 50%. So I'm kind of starting to hunt in that area. So
have you found any that are like very interested?
Yeah, and I don't know what I could talk about, so I'm gonna say I have nothing to add on that. Maybe in the next podcast I'll bring a couple ideas that.
Just have to check with your lawyer first.
I gotta check with the boss. That is Geoff Gannon. So, but I've been sending him a lot of different stocks. So we've been turning over a lot of rocks. So that's all we got for today on special edition. What's wrong, Warren? Of course, I'm being a bit facetious when I say that. Interesting times. This podcast, the rundown, is brought to you by quickfs.net, Vetla. And if you sign up for it, and in the survey, they tell them that they heard of them from Focus Compounding, we get a piece of that. And it helps keep the lights on, helps keep everything that we're doing. So definitely check it out. Geoff and I use QuickFS religiously every single day. It's a great way to pull financials of companies. And my favorite part is downloading an Excel file. And you have like a model right there that you can work off of and take notes. So we love it. Geoff loves it. And we use it every single day. So I want to thank everybody so much for tuning in with Vetla and myself. Follow us both on Twitter. Everything is down in the show notes. Hit the subscribe button. Thumbs this video up. And we will see you in the next rundown.